Welcome to the Phantom Trader world, where clarity comes before execution. Trading did not begin with charts, prices, or markets. It began with something far more basic: survival. Long before money existed, humans needed a way to exchange value. One person had food, another had tools, another had protection. They traded what they had for what they needed. This was the earliest form of trading. Not because people wanted profit, but because cooperation increased the chance of survival. In those early exchanges, value was not fixed. It was subjective. A product was worth whatever both sides agreed it was worth at that moment. But this system had a limitation. Trade could only happen if both sides wanted exactly what the other had. If that condition was not met, no trade occurred. As communities grew, this limitation slowed progress. This is where money appeared. Money was not created to make people rich. It was created to solve a problem. It became a shared language of value. Instead of exchanging goods directly, people could exchange value indirectly. Trade became faster, more flexible, and scalable. As trade expanded beyond villages and cities, risk increased. Long journeys were expensive. Goods could be lost. Ships could sink. Entire missions could fail. One person could no longer carry all the risk alone. This led to a new idea. What if many people shared the cost and also shared the reward? Instead of one trader risking everything, risk was divided. This concept changed trading forever. Ownership could now be split. Profits could be shared. Losses could be absorbed. Early organized markets emerged from this idea. People did not just trade goods anymore. They traded ownership. They traded expectations about the future. Prices started to move not only because of supply, but because of belief. Belief about what something could become worth. As more people wanted to buy, prices increased. As more people wanted to sell, prices fell. Supply and demand were no longer abstract ideas. They became visible forces. Early trading happened in informal places: ports, streets, coffee houses. Over time, rules were introduced. Records were kept. Trading hours were defined. Markets became more structured, but something important did not change. Human behavior. Fear existed then. Greed existed then. Hope and uncertainty existed then. The tools changed. The speed increased, but the human element remained. This is why history matters. When you understand how trading started, you stop seeing markets as artificial systems. You see them as reflections of human behavior. And once you see that, modern markets stop feeling mysterious. They become logical. Trading evolved from survival exchange to shared risk to organized markets. The foundation was never removed. It was only layered. Understanding this history does not make you a trader, but it gives you context. And without context, every market looks confusing. This foundation is what allows you to understand different trading approaches later without getting lost. If this video added clarity to how you see trading, support this work. An interaction tells the algorithm this foundation matters. A subscription tells me to keep building it with you.